put the screener on the back seat for now and go straight into the risk section, right? So right now, what you honestly have is you have a full approach to any market on any time frame, and you have a way to tell a story about that market, so you can actually go ahead and execute that given story and potentially get that trade right or make money on that move, right? Now, there's a few other steps in regards to making money on moves, and that's going to come down to risk. But that is the first part of what you have. Secondly, you have the ability to understand where to find the diamonds, the diamonds in the rough, the diamonds in the sand pile, the gold in the sand pile. You know how to locate those now. And one of the ways we do that is either you look through a ton of stuff and you decide the stuff that's best, or you have a simple filtration system. You have a screening system that allows you to spot the best things, so you can focus most of your efficiency, and your focus can go directly to finding the actual move and trading the potential pair or the potential move that you're actually taking. Now, the third step of actually doing all this is understanding management and risk basics, right? So what I'm going to try to do is I'm going to try to give you everything you really need about risk. Again, there's going to be a little bit of like psychology here, but most psychology is going to be in the webinars completely. And this is just the fundamental understandings you need to have behind risk, because most people in these markets go in completely empty-minded. They take trades, they buy up assets with random portions of their capital. They buy up huge positions, small positions, they mismanage, they lose a ton of money when they shouldn't lose a lot of money. This all comes down to management. Without all three of these things present, you are going to lose money. Even if you're the best trader in the world, even if you understand exactly how markets move and you get yourself into any move perfectly, if you don't have a proper understanding of how to manage your trades, how to get into trades, because you don't have a good understanding of risk or risk management or risk basics, you are going to lose your money even when you're correct. So it's vital that we now talk about risk and you actually understand how to calculate risk, think about risk, understand risk, buying power, everything that comes into that. And I'm going to make it as simple as possible, because I think it is crazy how complicated things are made online. So we start with the risk basics. The very, very first thing that all of you need to understand about your system is that your thought process is going to be entirely based in RR, where very simply, anytime you take a trade, your risk is 1 RR. That's it. That's all you need to understand right now. Every time you take a trade, all you have to understand is that you're risking 1 RR, which means anytime you take a full loss, it's always going to be minus 1 RR. That's it. So you can write that down. You can remember that. If you're already very advanced and understand this, it's okay. Just allow yourself to work through this. I'm going to make it as quick and efficient as possible. But if you get this understanding fully, you're going to be set for risk, and you're not going to make the dumb mistakes that most traders spend years making. Okay, so we think as traders in RR only, and everything is based on a unit measurement of 1 RR. So RR itself, okay, let's actually write this all out. RR itself simply stands for risk reward. Okay, so risk to reward. It's also known in some areas, in some places, whatever, it doesn't really matter, as a the risk to reward ratio. It doesn't matter how you classify or call it, but this is all it stands for, is just your risk to reward. So ultimately, you are only going to be thinking in 1 RR. So for instance, if I said you made 1 RR to like 5 RR, right? What does this mean? Well, this means that you took 1 RR of risk to make 5 RR of reward. You risked 1 to make 5. You had the potential to lose 1, but you used that 1 to make 5. You got a risk of reward 1 to 5. Now, we'll talk more about this in a second, so don't get, if this is a little confusing, that's okay. But all you need to understand initially, because you're going to hear this terminology again and again and again, and then it's going to make a lot of sense, is ultimately we are only thinking in RR. And I'm going to show you why in a second. 1 RR is also equal to exactly 1 unit of risk. That's all. 1 RR is 1 unit of risk. And most importantly, this unit of risk is preset and decided by you. So, for example, 1 RR can be equal to, 1% equity of your account. This could be 1% of your account size. Okay? 1 RR could equal 0.5% of your account size. 1 RR could equal 0.25, there's that number, percent of your account size. 1 RR could equal 2% of your account size. It doesn't matter. Notice something that's very important. The number is preset prior, whatever percentage that might be, and that is still always equal to 1 RR. So someone's 1 RR is going to have a different monetary value, a money value, than your potential RR. My 1 RR is going to have a different monetary value and potentially percentage equity value than your 1 RR. But anytime I take a loss and I take minus 1 RR, that is the same as you taking a loss and taking minus 1 RR, because everything is measured in the form of 1 RR. So once you've defined a percentage of your account size as how much you're going to risk of your account, let's assume 1% to start with. Let's say all of you have decided that going forward, you are going to have and risk 1% of your account. That is equal to 1 RR. Now notice something important. If your account size is $100,000, here you are, then your 1% risk, which is 1 RR, well, 1% of $100,000, that's 0.01, is $1,000. So your risk on any given trade, right, that you take right now will be equal to $1,000. So 1 RR, which is 1 unit of risk, which for you has been preset by your own decision at 1%, is equal to $1,000 currently. Let's say you won. Let's say you had a really good trade. Okay, let's say you won this trade and you returned 1 to 5R. Let's say a move started going, you got the trend right, and you made 5x return on what you risked. That means that you now made plus $5,000 on your account, which means your new account balance would be $105,000. Now, what is 1 RR for you? Well, it hasn't changed. 1% is still 1 RR. That is still your unit of risk, and that is how much you will risk on your next trade. But now the actual value has changed a little bit, because now you have $105,000 in your account, and 1% of that is $1,050. So your risk on your next potential trade, or on the next trade you take, is $1,050. But still, it's equal to 1 RR. And if you lose a trade, then your loss is still a loss of 1 RR. This is very simple, right? You can write this down. You can break this back. You can rewatch this just to understand this. But once you understand risk one time, you are set, because you have an actual understanding to applying risk. So we think in RR. That's the starting point. Everything starts with understanding what your loss looks like. Your loss, aka 1 RR or minus 1 RR, is equal to a percentage of the account. And that's 1 unit of risk. And that's going to have a monetary value, right? Based on the account size or any other equity percent of your account. Now, this, of course, is why, and I wrote this here, scaling in this game, I call it a game, but you can refer to it as you want, a skill or whatever, but this is specifically the skill or the game of trading, right? The reason I write this here is because this right here is the fundamental kind of building blocks that explain to you what is truly possible for you in this marketplace, in this skill set, right? Because if you get good at what you do, this thing right here, scaling, unlocks such a beautiful thing for you that it becomes absurd. What I mean by this is if you continuously return positive gain on your account and keep making money, right? As I wrote here, 1 RR on a 6 mil account, is executed. So let's say you're looking at a trade. Let's say you have the C. Let's say it moves into an accumulation. Let's say you look at the V. The V's already started moving beautifully in an MMB, and maybe you're looking inside of here on the E for an entry, and you see price come down to the MAs, maybe start your accumulations, and you enter this trade right here, right? And price starts to go. You have a risk of 1 RR. This would be minus 1 RR if price comes down, but it doesn't. It starts going. Maybe it goes and stops you out here. And this is a return of 5x your risk, right? The way that you would play this, for the most part, the execution that you just did, so this execution of the EVC aligning and you taking a trade, is going to be the same whether you're on a 6 million account, versus if you're on a 600K account. Because all you're doing at the end of the day is you're taking a 1RR risk, no matter what, on the given trade that you're taking, given that the liquidity exists. And I'll teach you guys how to calculate and make sure that you can take a trade based on the liquidity and the size of your account, right? The way that you execute this trade right here is the same way that you execute this trade right here. The very, very beautiful thing about this skill set, as I love to say, and this is a little bit psychological to help you guys in your own psychology, is that whether you're trading a $1,000 account, a $100,000 account, a $1 million account, a $10 million account, or a $100 million account, the act of what you do does not change. This is the only skill set in the world where the repeated action of the exact same thing can substantially and exponentially increase what you can make on an account, or what you can make in profit, or what you can make every single year, or every single 3 years, or every 10 years, right? Close to infinitely. This is the only skill set where that is possible. And that all comes down to the understanding of risk to reward and the fact that 1RR is 1 unit of risk. And simply with the growth of your account, or with just any starting account size, 1RR is going to be managed and traded pretty much the exact same way, which means, again, if you don't have the system worked out, you're going to lose money. If you have the system worked out, you're going to scale your money. This is the beauty of trading. Those two things are the fundamental building blocks of trading, right? So whether all of you are starting right now with a 6K account and you want to risk 1%, which is now equal to 1RR, 1% of 6K is $60. This is going to be 1RR for you. So anytime you take a trade, you're assuming a loss of $60 at this account size, right? Minus 1RR. Everything is from a unit of risk of 1RR, right? If you are trading 1% on a 600K account, all of a sudden your risk is simply $6,000 per trade. This is equal to 1RR. That means if you lose minus 1RR, which is a loss of 6K, 1%. That is preset. If it's 0.5%, it's 3K, etc. Right? If it's 1% at 6 mil, you're looking at a risk per trade of $60,000, which is equal to your 1RR, right? And this is how scaling and true profitability and making money in trading actually looks. Because for instance, let's imagine you're at even this level right here, right? If you on average, let's take a look actually at, let me go like this. If you take a look at just this data curve, where to go? If you take a look at this data curve, this is my own data curve from February up until recently. This is all for 2024. So 2025 is about to start. But again, this is going to apply for any of you that start collecting data and stuff. If you take a look at this, right, the RR return was 181 for the year, which is a return of around 442% where it's compounded. We'll talk about compounding and uncompounding later. Don't worry about that. But let's just say 181 RR. If you gained plus 181 RR after a year of doing this, that's what a year would be. That would be 181 RR times $6,000 because that's 1 RR for you, right? So if you have a 600K account, you're risking 1 RR, which is 6K. And if you've returned 181 R, then in that given year, you've returned $1,086,000. So what I want to make really clear right now with just this number is to define and show you what it looks like to be a profitable trader, be a full-time trader, make money trading, because there's a lot of people that still don't understand or believe that you can make money as a trader and live off of it. This is your fundamental understanding of why that happens. Many people might, and actually do, start with very small accounts. And as a result, with the same return, 181 RR, right? If you are starting with a $6,000 account, well, $60 at 181 R means that you made 10K in a year. Now, you are completely correct if you were to say, hey, it doesn't make sense that trading could be something you do full time or make a ton of money doing because, hey, clearly, if I'm risking $60 per trade and I have a 6K account, which is already kind of big, right? In some people's minds, it's already big. Then I'm only making 10K or 11K a year. And you're completely correct, right? Over time, This is why we scale our accounts, and why one of the things you should do is either you come and you have money so you can actually invest big time in yourself when you're ready to trade full time, or you have other things that you do in the real world, other things that you do in life that allow for you to start to increase your capital that you can then put into trading, because now you have a skill set that you can apply to that capital, right? That's very important to understand. So it's very important to understand that, if you are starting with a 6K account and you're risking 1% for each 1RR, and your return is, let's say, 181 RR in a year, yep, your gain is 10.8K. And if I asked you, is that something that you can live off full time over a year? If your answer is yes, then good for you. If the answer is no, then you need to understand that trading has this beautiful thing within it called scaling. And that's what makes the game absurd. And that is where, once you're trading a little bit of a bigger account, that same return with no differences other than the fact you're trading a larger account is now a return of $1 million. And if I asked you the same question, if you were trading if you had made $1 million in a year, would you be happy? The answer is going to be, I hope, a yes, because this already in 1 year, right, puts you in the top 0.001% of earners in the world. Okay, so like something along those lines. So just remember that. Okay, so this is the beauty of trading, and then we don't even have to talk about what it means when you continue to scale, right? So good traders continue to trade, they continue to scale, they continue to use bigger accounts, or people already come into the game with a lot of money, they learn the skill set, they get really good at the skill set, and then they apply it on their accounts. Well, that same 181R, because everything is from a thought process of RR, works out to about 10 mil gain over a year. Right. And again, same thing goes. This is what it looks like, and why trading is, of course, something that you can do as a full-time thing, or as as something that you can rely on. But the main question becomes, what is your starting capital and what are you doing this from? Right. So this is just your simple understanding of why this game is so absurd and what you're actually working towards as a trader. You're working towards understanding the skill set and getting the skill set down so much so that you can apply it to a sum of money, amount of capital. And this is just something that I really need you to understand for risk basics, which is that 1RR is a percentage of your account. This is what makes scaling in the game so absurd, because as your account grows, that 1% grows. We'll talk about that in the future. That's going to be based on compounding. I'm going to add a little thing about this right here, because it's very important that we talk about that, since it's going to be a part of how you make money. And ultimately, the next part of risk basics, right, is that we gain EV. So EV simply means, I'm going to make this clear, EV simply means expected value. When your overall trading has a positive expected value, you make money. Expected value simply, when you add up your wins and your losses over time, they prove to make money, right? So all this means is, if you have, let's say, a 30% win rate, right, and 30% of the time you make, let's say, 5RR plus 5RR, but then 70% of the time, you lose 1RR, right? So let's say you have a 30% win rate, you make 5RR every time you win, but 70% of the time you lose, right? Is this a profitable system? Well, this is where you add everything up. This is where this kind of math comes in. If you've done math in high school, there's very likely you've learned something like this, but this is what EV truly looks like, right? If I have a 30% win rate, so 0.3x time, 30% of the time here, 30% of the time I make 5R, okay, 150. Minus 70% of the time, I make minus 1. 70% of the time, I make minus 1, which is negative 70. Does that work out to a positive number? Of course. This becomes positive 80. So over time, no matter what I do, if I execute a system like this, I'm going to make money. This is what EV is, right? So we gain EV through the lens of RR, right? Because RR defines we either lose or we gain a certain amount per trade. And if overall it works out to a positive number, we are profitable, right? And the question that everything comes down to from a risk basics perspective is, do you as a trader make positive RR over time or not? That's it. That's the entirety of trading. Take a look at this. If you make more RR over time than you lose, so you take a minus 1, you take a minus 1, you take a minus 1, you make 8 RR, you make a minus 1, minus 1, minus 1, you make plus 3 RR, you make a minus 1, minus 1, minus 1, you make a plus 8 RR, you make a minus 1, minus 1, minus 1, you make a plus 8 RR, right? Minus 3 plus 8 is 5, 4, 3, 2, 5, 4, 3, 2, 10, 9, 8, 7, 7 plus 8 is 15. So this overall is up to 15. If all I had for my data was a system that looked like this, I have a profitable system. Now, this is one of the reasons that it's very important that in the beginning, especially for a lot of you that might be more beginners or might be advanced but have actually now learned how to properly think about trading, this is why it's very important that in the beginning, you get up to 100 or more instances of this. So you can truly measure if over a good amount of trades, you have a positive number. Because if you do, that is a profitable system, and that's all. I really want this to kind of cut deep. There's a lot of work that goes into actually making this happen. There's a lot of work that you're going to be doing with case studying, with collecting data, with getting better at this, with using the screener to make your own findings more efficient. But ultimately, if over a certain amount of trades, over a lot of trades, you have a positive number in terms of all the returns, that is a profitable system. And as a result, you've done the work. That is all there is to it. The next step would be executing. Okay, and we'll talk about the steps of going through the steps of collecting data, of knowing what you're doing, of when to go live, when to go forward test, and everything. But this is ultimately everything trading has ever come down to. If through the lens of RR, with 1 unit of risk, you are returning positive RR over a good amount of trades, over a large amount of trades. So think 500 plus, think 200 plus. That's it, guys. You have a profitable system under your hands, right? If you go in and you do the analysis every single day, ignore that, it's for my video games. But if every day you go in and you record and you look for things that you're going to trade and you trade those things, and over time you take your break evens, you take your losses, you take your small wins, you take your big wins, you take your losses, you take your big wins, and over 100, 200 trades, that adds up to a positive value, you are a profitable trader. And now it's just a question of putting capital to work, or finding capital to put to work, or scaling your capital to have more capital, which is finding capital to put it to work. Okay. So once you've determined what 1RR is for you, that's going to define how, if you're capable of trading a certain asset on a given time frame. And this is the next crucial part. So again, once you've defined what 1RR is, right? So for some people, 1RR, based on their account size, is going to be a 60K risk. For some people, it's going to be a $60 risk. Some people, it's going to be a 6K risk. This is going to define what assets you're actually able to trade. And we'll talk about that in the coming Risk Basics videos. But the very first one, and the main focus I want to define, is simply understanding this right here. And this is the entirety of your foundation for Risk Basics. Everything is based on a thought process in RR. It's based on how much am I going to lose on a losing trade. That is 1RR for you. Is that 1%? Is that 0.5%? This is something for you to determine. Now, for me personally, okay, I have for a very long time played between 0.5 to 1% risk. Mainly 0.5% risk, okay? This is because we'll talk about the reasons for that, but this is just what I by default use. Many traders by default use 1%. What I would say is that the lower your account, the more likely you're going to be able to use 1% and be happy to do that. The higher your account gets, the more scaling you do, the more likely you're going to move towards 0.5% or lower because, well, you have a lot more money, and doing the same actions makes you a lot more money than you would have made before. And we'll talk about the reasons for that later. This is just based on account sizes. You can think back to this, right? The person risking 0.5% on his account that it's 6 mil, that's a 30K risk per trade. The person risking 1% on a 6K account is risking $60 per trade. So even if both of these traders make 5x reward on their risk, this trader's making 5, 10, 15, 20, 25, 30, is making $300 of profit. This guy right here is making 150K of profit, right? So of course, like as your account grows, you'll be more willing to reduce the risk, which is equal to 1RR, than keep it the same or keep it high because, well, you have a much bigger account and you need a lot less to live, as I talk about in the webinars. But this is the very starting point, right? I use 0.5% risk. So for me, that's equal to 1RR. And that is it. That is what I apply to each trade that I take. And if I lose, I am looking to lose -1RR. Now, in the next video, we'll go into further risk to reward, like what does it actually mean? And then we'll get into this, where after you've determined what are for you, let's learn to define if you're capable of trading a certain asset on a given time frame, right? Because it's very important to understand that you can actually put money behind a certain asset. Okay, I'll see you guys in the next one.